Good day, fellow investors. Following the Brazilian team, let's look at Ambev. Ambev is Latin America's top beer and soft drink producer with a stable demand from its stable industry. Large scale, market share, strong demands, and high entry barriers for competitors, giving it a nice moat. Management is aligned with controlling shareholder AB InBev, the European giant, and has a reasonable incentive structure and a nice dividend policy. From a margin of safety side, it's fairly priced with a strong balance sheet, and the company is highly profitable. As just mentioned, on the right side, you can see InBev is basically controlling 60% plus of the company, followed by FAHZ, which is a Brazilian non-profit foundation using the dividend to fund social programs. It has a deep history with the company, and you can learn that if you're interested on the company's history. The rest of the shares are publicly traded and some treasury shares from buybacks. The company is Latin America's leading beer and soft drink producer, effectively the arm of AB InBev. Ambev actually means America's beverage company. It has a strong recurring demand because it's a consumer staple and has a nice growth, around 5% compounded average growth rate over the past 8 years, and has a nice macro backdrop with the emerging markets in mainly Latin America. I say mainly because it has a large Canadian business, 17% of its EBITDA, but of course the business is dominated by Brazilian beer, and not just Brazil. Brazilian non-alcoholic beverages listed as a segment separate from Brazilian beer. You have the beer, you have Canada, you have other Latin American South countries, you have the Caribbean and Central American region. So it's relatively well diversified and not just focused on one country. It has a nice moat with scale, distribution, and logistics unmatched by others. It's capitally intensive for new entrants to compete with them, not to mention their brands and licenses with other companies such as Pepsi. They have a really dominant market share in Brazil, almost 70%, and other Latin American markets are also 60% plus. Consumer loyalty for brands are obviously a pricing power. They have numerous risks from input costs such as aluminum and FX swings. We know that the Brazilian real had seen better days, although recently it's been stabilizing with a nice vol to carry ratio. Maybe I will make a video on that. And of course, regulatory and risk like the recent VAT changes or the shifting tastes, which is risks for every beverage company. You can see some brands, but they have more than these. And if you're interested, you can find it on their website or in their annual report. From a management perspective, their incentive structure is reasonable. They have EBITDA, cash generation, and volume growth, although not as transparent I would like. And these are not as clear, and also these were not as easy to find. I found them in the governance report and not in their annual 20F filing. The dividend policy is decent with a 40% of net profits, and they may distribute more than that. Of course, because the major shareholder InBev wants to see remittances to the holding company from Ambev. You can see that top management, the executives, received 152 million, which is roughly $28.5 million US dollars for 13 executives. That's 2.2 million per executive. Not outlandish, although higher than I would have expected from a Brazilian company. Let's look at the remuneration history. On this chart, you can see the ADR, the American Depository Share, which is in US dollars. On the background, you see that they dropped just before 2020 COVID pandemic. This drop actually is likely, it's tied to the Brazilian real depreciation against the dollar, and then you can see it's sort of stabilized over the past 5 years, while you had growth of free cash flow. Actually, from 2018 to 2024, the growth was 5.4% compounded annually. although these numbers are in Brazilian real, so in dollar the growth probably was slightly less. You can see that they have a nice free cash flows, which they mostly use for paying dividends, given the mother company InBev wants to see the remittances. But also in the recent years, they started to do some buybacks. But given that I think the company is trading below intrinsic value, buybacks would make sense here. But of course, stable dividends are nice. Let's take a look at their balance sheet, comparing. If you look at this table, I think if you want to go into the details, I left some numbers here, but we can just focus on the table here. Comparing last year ends of 24 to quarter 2 2025, you can see that their currency. Oh yeah, I wanted to look at this because when I was looking at the quarterly report, I saw their cash position dropped from 28 plus billion real to 16 billion, and I didn't know why. So I took a look. I see that what I found is in the table that their currency ratio actually improved. Their debt to equity was really low. Basically, they have no debt, but that's also an improvement. You can see that if you add up all the tax assets minus all the tax liabilities, they actually improved there. So some cash went to balance the tax side, which was influenced by the VAT changes in Brazil. You can see that they also paid down net receipt, so they paid down then trade payables. If you compare also like as you did with taxes, all your receivables versus payables, they also paid that down. And in total, if you look at the equity divided by total assets, their position increased. So their balance sheet is better than it was year end. So this cash down actually didn't really change the picture. They just paid off taxes, paid off trade payables, and actually they paid off. If you look at this line here, this is dividends and interest on shareholder equity on the liability side. So they also paid out some dividends. So taxes, trade payables, dividends, balance sheet better than it was. Nothing's wrong here. From a margin of safety perspective, I think the intrinsic value is around 16 Brazilian real. What I use to calculate that is a historical compounded annual growth rate of 5.4% projected with a discount rate of 10%. We could argue that it should be higher than 10%, given that the Brazilian interest rates of the 10-year is just below 14%, but their inflation is at 5.5% as of the latest number I saw. So I'm fine with this. And if we look at the company's profitability, you can see that return on equity is better than it was on the 7-year average. Their return on investment is better. What I really like for companies like this is return on tangible assets, because these companies have a lot of brands which are non-tangible assets, goodwill on the balance sheet. It's kind of flat compared to the 7-year average, but these are really nice numbers, like 20%. It's amazing. They have nice free cash flow margins. They have basically no debt, and they have enough liquidity to cover their interest many times over. So there is no default risk at all. It's really hard to default without debt, actually. And as previously mentioned, every time I'm going to analyze a stock, I'm going to put it on the stock summary table. You can see Ambev here, just below, between Petrobras and Vale, and all the numbers we've seen so far. So if you like the video, please subscribe and like it. If you have any stock ideas, let me know and I'll take a look. Thank you for watching, and see you next time. Take care.